Joining me is President and Chief Executive Officer, Phil Baker. Phil, very good afternoon to you, and thank you very much indeed for joining us.
Glad to be here.
Let me ask you first of all about that outperformance from your share price. You must be delighted.
We are very pleased with the outperformance, and it comes really over a long period of time of making change at Hecla Mining Company. And as those changes have resulted in really records on so many fronts in 2014. Most revenue, most metals produced, most silver produced, the highest silver reserves in the history of the company, all came in 2014. And it came on the back of a difficult 2012, an improving 2013, and then we have 2014 with these record performance. And the market has begun to understand that, and we've seen this outperformance really over the course of the last almost 9 months now.
But could I ask you just to outline for investors what the company's strategy is at the moment? Is it precious metals in North America? And when I say North America, I mean Mexico as well. But
Sure.
Is that the focus of the company? Or could you, if the right opportunity arose elsewhere in the planet, in the hemisphere, would you be prepared to go further afield? Would you be prepared to go beyond silver and gold?
So we have been a silver producer for over 124 years now. We have been a gold producer for almost 35 years. Coming with those metals has come base metals, and we're happy to have that. We like having the lead and zinc production. We just recently announced the acquisition of a company that has copper in its resources. So at some point you'll see us also producing copper. But the key for us is high quality assets, and those assets can be in North America or they can be elsewhere. We currently have a mine in Alaska, a mine in Idaho, a mine in Quebec. But we were, if you go back until 2008, we were the largest gold producer in Venezuela. So we've been pretty far afield from North America, and we're prepared to really search the globe for these high quality assets that really meet the criteria that we're looking for, which is long mine lives, large land positions, the opportunity to learn from the geology, learn from the operations, and be able to deliver value to shareholders in the form of production, but also in the form of operational improvements, geologic success.
Your most recent venture, I suppose, is Revet Mining.
Correct.
Tell us a little bit about the rationale behind that, why you were prepared to make the offer you did, and also, if you could, how you evaluated the company, why you decided to make the offer you did when you decided to make it and at the price that you did.
Revet is a company that we have followed for a long time. It's a company that has done a particularly good job of advancing a project called the Rock Creek Project. And that's really what we were interested in. Rock Creek is a deposit that has 250 million ounces of silver, has 2 billion pounds of copper. It will be a low-cost operation. It will be an operation that will operate for 20, 30 years plus. The issue that Rock Creek has had has been permitting. And what Revet has been able to do over the course of the last basically 10 years is advance that permitting where you can actually see this thing go into production sometime in the next decade or so. That is a huge advancement in this asset. And so we just saw this as being the right time to bring this into the Hecla portfolio, because we think about things in terms of the next quarter, the next 5 years, the next 10 years, and that falls into the category of something that's going to be in our long-term future.
When I looked at their resource, I think it was mostly inferred.
Yeah, it's an inferred resource, but it is very continuous. It is very similar to what Revet and a company called Asarco mined for over 20 years. So it's something that is well known, and we're highly confident in what the ore body itself will look like and what the costs associated with operating that ore body. This is not a new discovery by any means.
Will it require a lot of investment to bring into production?
When the time comes, yes, but that's still a long ways off that development. It's probably order of magnitude in the studies that have been done by Revet, order of magnitude $300 million. It's probably going to be more than that when we do the analysis, but It's not going to be a huge amount of, it's not going to be $1 billion sort of project. It will certainly be $500 million in that order of magnitude.
But that raises the possibility in my mind that you could fund this, or at least part fund this, with a streaming deal. Would that in principle be a route you could go down?
Yeah, that's certainly possible. There's going to be a lot of opportunities to fund this project, not the least of which is the cash flow generation that we have from Greens Creek, Lucky Friday, and Casa Berardi. All cash flow positive properties when the Lucky Friday becomes fully operational with the deeper mineralization. So we'll be in a very good position to take this thing forward with our own cash flow, with off our balance sheet. Possible to do streaming, but we also have these other opportunities.
Of course, a capital commitment in some time in the future of that sort of magnitude, it is, or is sometimes perceived by investors to be in opposition to the potential for dividends. How would you balance those two things?
Well, we're currently a dividend-paying company, and we have a positive view towards providing more dividends as prices are higher. We, in fact, put in place in 2011 a policy that provides just that, and we would anticipate in the future doing more of the same.
Is the dividend policy a progressive one, or is it dependent?
Very progressive. So as the silver price rises, there's more dividends to shareholders.
Is that going to be your last acquisition for a while, Rivette, or look, the jury's out, and if you get the right opportunity at the right price, you'll still be prepared to entertain it?
So in this industry, you're constantly looking at things you might add to the portfolio, but most of the time those don't come to pass because it takes a lot of analysis, and it takes two parties to come to an agreement as to what an asset's worth. So we'll continue to do that. We'll continue to look at assets, continue to look at bringing new assets into the mix. We're fortunate in that we have the strength to do things that other companies don't, hence why we made the transaction for Rivette, why we're looking at other assets and companies that we might be able to transact with. However, we're in the fortunate position, and in my almost 30 years in the business, it's really the first company that I've worked for that does not have really a production cliff in front of them that's short term. We have decades before you'll see the existing assets reach the end of their mine lives. So we've got lots of production in front of us. We can add to that production, or we can just continue to rely on that production and the growth in that production from the organic assets that we have.
You talked about that cash flow, and you talked about the production cliff, which in this case you don't have. Is that the secret behind your outperformance? Is your share price outperformance over the last few months?
Look, I think that's part of it. There's a recognition that the company, or there's beginning to be a recognition that the company has fundamentally changed. If you go back and look at where we were in 2012, it has been a material increase in our production, almost 200% increase in the production from where we were in 2012. Part of that is the acquisition of Orebody and Casa Berardi. Part of it has been the Lucky Friday going back into full production. So those two things have, and the continued outperformance of Greens Creek. So those three things, the market is starting to recognize that. And when I look forward, I see more of that from those three properties. Plus, I see it at San Sebastian, a property that we've had in Mexico for 15 years. We operated for 5. For the last 10, we've been exploring. And we have, in the last 18 months, cracked the code. We understand now the process that we need to go through in order to identify the veins that have the mineralization. Result of that, we've caused this asset to now have about 75 million silver equivalent ounces, and we've identified within that 75 million silver equivalent ounces a portion of it that is super high grade. And what we're looking at now is how do we monetize that small portion quickly? And basically what we've looked at is an open pit mine that we will process through someone else's mill. And it will be a game changer for San Sebastian It will allow that to go back into production quite quickly, generate lots of cash flow, and really put ourselves in a position to develop that thing over the long haul based on the rest of the asset that we've discovered.
We've talked about a little bit about corporate growth, mergers and acquisitions opportunities. You do have organic growth possibilities in the form of San Sebastian.
San Sebastian and the Lucky Friday. Remember, at the Lucky Friday, we're developing an internal shaft that's going to go to about 8,800 feet below the surface. It's going to put us in a position to operate for 30 plus years, and it allows us to access ore that's much higher grade, about a third higher than what we're mining today. So we're going to increase the ounces without having to increase the tons. And that's the recipe for high margin asset. So you'll see the Lucky Friday go to about a 5 million ounce producer from 3, and you'll see it do that for decades to come.
Right, this is a completely new shaft. So how long before it's fully developed, fully operational?
So the excavation will be done this year. The complete equipping of the shaft will be done by the third quarter of next year.
Your gearing position is pretty moderate at the moment, I think it'd be fair to say. But...
Well, we have debt.
Yeah.
It's long-term debt. It's debt whose cost is after tax about 5%. It's due in 2021. There's no covenants that we have to meet that could put us in, other than paying the interest, that could put us in harm's way. We look at it as a permanent form of capital, and what we're looking to do between now and its due date is improve the credit quality of the company, and then extend the debt further into the future and continue to do that as the credit quality improves. Hopefully, prices of the metals will have improved as well, but even if they don't, as long as the production is increasing on a relatively consistent cost basis, our economics will improve, and we should be able to roll that debt further out.
So here you are. You sound almost unique to me in the world of mining.
I think we are unique. I think that's what the market is starting to recognize. We are very unique to have a company that has long-lived assets, low-cost assets that are in the U.S. and Canada, and soon in Mexico with San Sebastian, and debt that is low-cost, long-lived, not something that's strangling the company. That's a pretty unique place in this sector.
It's a wonderful story. Excellent, Phil. Thank you very much indeed. That was Phil S. Baker, Jr., the President and Chief Executive Officer of Hecla Mining, ticker HL. I'm Charlie Gibson, the Director and Sector Head of Mining at Edison, and you're watching Edison TV.